Looked like we got some much needed rain last night.
Yeah, and it sounds like
Yeah,
some coming.
yeah. All right. Well, good morning, everybody. This meeting of the Sinking Fund Commission is being conducted via Microsoft Teams and pursuant to Section 21-1503 of the Philadelphia Code. Electronic recordings of the meeting will be made available through the conference technology and via audio recording. Recording of this meeting will be made available to the public online at the Commission's website, free of charge within 10 days. And please note that you consent to the recording by attending, participating, or speaking at the meeting. With that, I will turn it over to Chairman for the first agenda item.
Thank you, Christopher, and let me extend a hearty welcome to all of the board members and everyone else who's on the phone here. The first order of business is the approval of the September 2024 Sinking Fund Commission transcript. Is there a motion?
So moved.
Second?
Yes, second the motion, Don.
All right. Motion has been made and properly seconded. All those in favor, just say aye.
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 Motion passed. Before I go on to the second item on the agenda, let me go back to Christopher to see if he has any opening remarks.
No, other than, just to say the next agenda item is the asset allocation and scenario analysis to be covered primarily by Marquette and Quaco. If you want to tell me what document or documents you want up on the screen, I will try to manage the PDFs while you're speaking.
Sure. Chris, I can we can start with the supplemental asset allocation slides, and if you want, I can also navigate if that's easier. So you let me know, and I'm happy to.
If you want to share, that's fine. I can
Okay, perfect.
stop, and then if you want to put stuff up, that's fine.
Just in case when the questions come up, I'll be able to
Yep.
kind of go back and forth on the documents. So
Yep.
Perfect. So with that, if you think it makes sense, Chris, the goal would be to start with the supplemental slides with the asset allocation. That way, before we go into the asset allocation, we can kind of talk about some new asset classes or strategies that we're looking to incorporate in some of the mixes.
Sure.
If you think that works, I can
Yep.
start with that. Okay, great.
Yep.
Perfect. So I'll begin with the supplemental slides, and I should start with a good morning to everyone as well. For those of you that have just met me, my name's Kwaku Obed. I am one of your senior consultants on the Marquette team, and the goal today is to walk through the asset allocation. Ultimately, we're just looking at making, in our opinion, some tweaks to what has worked really, really well for you. Those tweaks are going to focus on a little bit of downside protection, a little bit of volatility management, and we can go into that momentarily. But let me jump into this presentation first. And, as always, please feel free to stop me, ask any questions along the way. So this slide here just points to the breakdown of the US stock market. And the reason why we've added this slide in is to incorporate a discussion around mid-cap equities. So right now, the legacy allocation has exposure to US large cap. So you can think about your stocks like your Amazons, and then we have small cap. So you can think about your stocks like Land's End. What we're also looking to incorporate within the new asset allocation is a dedicated exposure to mid-cap stocks. And for mid-cap, you can think about your stocks that are between 2 and 10 billion. And a good example of that would be a multinational like Hasbro. So just wanted to start off with that because that's one of the tweaks that we're looking to incorporate within the asset allocation. As we think about the sector allocations of your large cap, mid cap, and small cap, I'm going to make this a little larger selfishly for myself because I cannot see it. One of the other benefits of adding that dedicated mid cap exposure, in our opinion, is just a little bit more diversification from this very concentrated market that we've been in. So I'm sure at prior meetings, you've spoken about the Magnificent Seven, you've spoken about growth, technology, AI, and how that has really led the performance in the US equity market. And as we think about mid cap and small cap will offer a little bit more diversification to the very strong large cap trend that we've seen. We're not calling the end of the trend, but what we are trying to do here is just add a little bit more diversification. So as we go through pullbacks in the market, we can think about October being a good example of the market pulling back. We can think about post-election, just how much volatility we've seen in the marketplace. Just having a little bit more diversification, we feel is definitely in the right order. So just wanted to mention here this slide, and as it goes through some of the different sector exposure, S&P 500, for example, you're looking at around a third of exposure to IT from the S&P 500. If you add communication services to that mix, you're essentially looking at around 40% of the S&P 500 being beholden to the technology trade. So again, a little diversification we feel is a prudent step forward in the asset allocation. And then this is a conversation we've had with some of you for another pool of assets, but really with low vol equities. What we wanted to do here is just introduce the concept for the sinking fund portfolio. And again, with the sinking fund portfolio and its good returns in mind, the goal here is to talk about the downside, right? We've gone through a very strong bull market, particularly in the post-COVID environment. We saw interest rates go up pretty tremendously in 2022. So with the exception of that 1 year like 2022, what we've really benefited from has been a meteoric rise in the marketplace. We've essentially looked at equities continuing to just break records. And by adding a sleeve in the portfolio that kind of looks at the worst case scenario, or the fact that the market does go through downturns, the market does go through sell-offs, what we're trying to incorporate is a very small sliver of around 5% in a lower beta strategy. And by lower beta, what's the mathematics behind that? Well, with lower beta, you think about the market going up, the market going down. When we think about losses and gains, these are not symmetrical. And if we think about this particular exhibit here, for example, it highlights if the portfolio sells off or if the market sells off, let's say, for example, 40%, you would have to return 67% to get back to that same starting point you're at before that 40% loss. If you lost 50%, you'd have to recoup 100% to get back to that starting point you're at before that 50% loss. So by incorporating a portion of the portfolio that is expected to not underperform as the market draws down to the same extent as the market, it just puts a little bit less pressure on the other areas of the portfolio. And as we think about the reality of the plan is in good standing. We think about the target rate of return, very achievable at 7%. So that's definitely a big check on the plus side. And then we think about the funded status. It's around 75, 76%, which is a good number. But again, 75, 76%, we want to be mindful of the fact that in periods where the market goes down, we don't want to feel the brunt of the market going down. And in other plans that we work on, a year like 2022, this is basically what we saw in the marketplace. The plans that had a little bit more diversification away from equities, your traditional equities and your traditional fixed income, in a year like 2022, where the market sold off, we actually saw your real assets and some of the other private market allocations really, really defend on the downside, and they helped maintain the overall base of those portfolios. So again, that's really the rationale and the thinking as we talk about low beta, low volatility, and that type of investing. So as we think about low volatility equity stocks, what does it really mean? It's a manager selection decision when all is said and done. But we think about a long only portfolio, meaning that there's no shorting, there's nothing esoteric going on at the portfolio level. It's really around sector selection and stock selection. So what we end up with is a very liquid portfolio, low fees, and then the availability of strategies is actually pretty good. Commingled funds, separate accounts. I know due to state statutes, we'd be leaning towards a separately managed account. But with that being said, a pretty good availability of products out there. And then the case for low vol equity, and this is where it's definitely, for me, it took a while to really get my arms around this. But as we think about the market and we think about the investment horizon of a long-term investor, there will be periods where, the market blips, the market goes up, the market goes down. And it's really just the accrued returns over time with low vol, where you truly see the value being added through low vol. So if consistently, more often than not, a low vol or lower beta strategy is losing less than the market, but then still participating in the upside over a full cycle, that's where you really start seeing those returns even out with the broader market with significantly less volatility. And really, the point of this exhibit is to show that as we think about your higher beta stocks versus your lower beta stocks, a higher beta stock doesn't necessarily mean high return. And that's really the thinking here, again, as we think about a low vol allocation within a portfolio. So with low vol strategies, again, we're looking at strategies that are making sector bets. We're not looking at, a very short-term horizon. This is over a full market cycle. You're looking at plays across the market cap spectrum. You're looking at exposures to your defensive sectors, and we'll jump to that momentarily, where we'll see a slide that breaks down the exposure of a min vol strategy versus your traditional benchmark. And as an example, we can expect less in, let's say, IT, and we can expect more in your, utilities or your consumer staples. That's just an example of some of the sector exposures we see in a low vol strategy. With respect to the opportunity set, we have discussed this before. So from a pro standpoint, we're looking at downside protection. We're looking at, again, lower volatility over a market cap. Now, one of the cons, one of the takeaways would be, as we think about the volatility in the market, there may be periods where a low vol strategy will exhibit tracking error, deviation relative to the benchmark. We obviously like to see positive deviation relative to the benchmark. But to give you an example of, an anomaly that took place with low vol, in 2020, low vol held up pretty well, but it did not hold up as well as your growth sectors. And that was pretty interesting. We had COVID, everything shut down, there was a sell-off, but then you saw the GameStops of the world, go through the roof. And the market environment was not one where investors really favored the true fundamentals of the stocks. So that was a pretty interesting environment where we saw tracking error from your low vol strategies, but we still remain convicted in low vol and its ability, because that example I just gave was an example of the market or animal spirits in the market really not leading to the right fundamentals or the right themes being rewarded. As and when there was a pullback and as and when there was a cooling off, we did see low vol actually hold up pretty well. Low vol managers can exhibit higher turnover. So if certain stocks from a valuation standpoint creep up a lot quickly, we've seen the market move pretty tremendously. Post-election, for example, the market rallied tremendously. The notion of tax cuts, the notion of having more benefits, more deregulation, the market absorbed that really positively. But then on the flip side, as cabinet picks started getting floated out, the market did retreat pretty extensively because on the one hand, you've got the benefits of lower tax cuts and so on. On the other hand, there are the very real potential social impacts of the new administration. So in that type of environment, you may see higher than typical turnover in a low vol portfolio. And then in extremely strong markets, again, like a 2020, where your GameStops were going through the roof, you may see your low vol lag the broader market pretty significantly. But again, with that lens of this is over a full market cycle, the goal is to protect from the downside. And going back to the non-symmetrical nature of returns, where if you lose 50% of something, but you have to return 100% to get back to that same starting point, that's the real goal of low vol. And within the asset allocation, you'll see that we have a relatively small allocation there because we want to factor in some of those cons that we just mentioned, along with the very tangible pros. With the sector allocations, very quickly, in the blue, this points to the broad benchmark. So this is the core benchmark. And then the green would point to a low volatility approach. So as an example, you'll see that energy, one of the more volatile sectors out there, is going to be underweight. And in an environment where energy rallies, we saw that, shortly after the shutdown. That's an example of an area where low vol could fall back relative to the benchmark. But again, energy is highly volatile. It's not a long-term play that works out in any way. It typically washes out. So being underweight energy, that's what we expect from your low vol strategy.
Waco,
Yes.
what period of time are these returns for?
Fran, this is as of September 30th, 2024.
For what period?
So this is for the actual month, I want to say, of September 30th, 2024. So it's just the snapshot in time
For 1 month?
the 1 month. That's correct.
Okay, all right,
Yes.
thank you.
And we'll see here, for example, IT. IT is a lower weighting. It still is a weighting in the low vol benchmark, but it is a lower weighting. So utilities, IT, these are some of the sectors that have a higher weighting in, or I should say, utilities. Financials would have a higher weighting. IT would have a weighting, but not as high as the benchmark. So as we see here, and September was a pretty volatile period leading up to the election, leading up to, will the Fed lower interest rates? Will the Fed keep rates the same? All of the noise that increased in the marketplace led to more volatility. So this period here, again, just for the month of September, just gives you a sense of, which factors were rewarded pretty well within the market. And we do see here, for example, low vol, holding up pretty nicely in that September period. October, we would have seen a continuation of that. November, the month is, still upon us. So very hard to say, where things stand, but low vol has held up pretty well as we think about the sell-offs we've seen on the core portion of things. So again, as we've seen more volatility, we've seen the low vol factor actually get rewarded a little bit more. And we never look to time the market. We're not market timers, we're long-term investors, but we think about the way the market has absorbed the news of the new administration. Again, November 6th, the market rallied. It wasn't a contested election. Some of the projections did not come to fruition. And I think the relief of not going through just big civil chaos around the election result that was a pretty strong tailwind for the market. But then when we think about foreign policy, we think about some of the cabinet picks and what that may mean. Ultimately, the market continues to absorb this in a very, very animal spirit fashion. On one particular day, NVIDIA comes out with its release, and the market suddenly forgets all the social problems it's worried about. And then suddenly, when NVIDIA is in the rearview mirror, all of a sudden there's a concern around, what does this pick mean for this particular department and so on. So it appears that volatility will be more on the horizon. So while we're not market timers, we do think that the environment we're going into, would be one that benefits from a sliver of the portfolio acting defensively. And then as we think about longer term returns, we definitely do see here, for example, again, with low vol, when you have flat and down markets, low vol in the green, you'll see outperformance, I should say there. So a year like 2008, pretty meaningful outperformance from a downside protection standpoint. In a year like 2022, again, rates went up, and all equities, all fixed income essentially sold off. Low vol, comfortably defended on the downside. So really, as we think about another year like 2018, that's when the prospect of rates going up again led to a pretty extreme market sell-off at the end of the year. We did see low vol really hold up nicely. A year like 2011, this was the taper tantrum, I want to say. Low vol was actually up while the broader market was down. So again, in those down to flat environments, we do see low vol hold up well. And then, as noted earlier, in your very extreme market rallies, you'll see low vol. It's a lower beta strategy. It will be up, but it will lag the broader market. And that type of return stream over a full market cycle ultimately is what leads to returns that are in line with the index, but with significantly lower standard deviation. So this paints that longer term picture of how low vol has performed across different market environments. So the next area I just wanted to touch upon is infrastructure. So within the asset allocation, I mentioned mid-cap being an area where we'll have proxy exposure to mid-cap through even the index funds or even through small cap just because of size creep. But dedicated exposure to mid-cap is what we're proposing in the asset allocation. Dedicated exposure to low vol is also what we are proposing. And then the third lever would also be infrastructure. So this is where we are proposing a new allocation within the portfolio. So what I wanted to do here is very quickly go through infrastructure, why we think it makes sense within a portfolio. And then once we've gone through that, we can then dive into the asset allocation with this background on these three newer areas in our back pocket for any questions that come up. So with infrastructure, this is an asset class that really invests in physical assets that we consider to be the backbone of any economy. I'm just going to take a quick sip. As we think about an infrastructure investment, these are goods and services that are essential to society. So we can think about, power plants, toll roads, airports. The firms that we typically invest in, you're not looking at prisons or municipal assets that wouldn't serve the greater good. So that's an example of an area where we're not looking to profit from, let's say, incarceration. I know that's an area that's been discussed with clients, at the municipal level. So just wanted to mention that as we think about the types of assets we're investing in, these could be, hospitals, toll roads, airports. And again, there's typically a monopoly type situation with these assets. Why is that important? Well, with a monopoly situation, you have what's known as a low elasticity of demand, meaning that these are essential goods. these are essential goods that are regulated. And with the low elasticity of demand, it means that you can pretty much bank upon a pretty predictable cash flow and cash stream coming. So that's one of the key benefits there as we think about infrastructure, less about appreciation, more about a cash yield. And then we've mentioned the equity markets, the fixed income markets. They go through volatility, in a pretty extreme measure. Just having those stable and predictable cash flows are a way to smooth out some of the more volatile periods that we can run into in the liquid markets. The other thing which is really interesting here is the inflation protection component. Up until COVID, it was something that was kind of just mentioned that, okay, inflation protection is an added benefit, but inflation post-COVID is something that's definitely been discussed around many tables with many investors, and the inflation protection benefit of infrastructure definitely is now seen in this post-COVID environment as a pretty nice benefit of the asset class. Again, if you think about low elasticity of demand, you think about essential goods and services, these services are going to essentially absorb the inflationary pressures that do come with rising prices. And as we think about the types of infrastructure assets that are available, again, you're looking at utilities, energy, transportation. These are OECD countries. So when we think about the asset class, we're not investing in emerging economies. We're not investing in non-developed economies. You're typically looking at your Australia's, your Europe's, and your US infrastructure investments. And as an asset class, you're essentially investing, if you think about the type of infrastructure we'd be proposing, you're investing in your more mature, already established types of infrastructure operations. These are your brownfield entities. So with your brownfields, you're looking at, again, your stable and predictable cash flows because you're not building something that's brand new. In fact, you're buying ownership in something that already exists. So you're essentially buying into that revenue stream that exists. There are very high barriers to entry when we think about entering this market. So to own an infrastructure asset in a open-end structure, you have to have a lot of buying power. And ultimately, the funds that we're looking at have had the buying power and the ability to literally own some of these immense assets within their portfolio. When we think about investment grade financing, this goes back to these brownfield types of entities where if there is any type of financing or leverage used, it's really around maintaining operations or moving operations to greener standards, as opposed to building something from scratch and then taking on a very, very heavy debt position. So to really just capture this page once again, we just get a sense of some of the areas the infrastructure managers would invest in. Utilities, you've got gas, electric, water, telecom, energy. We think about pipelines as an example. Transportation, you have toll roads, seaports, airports, and again, this is a very diversified portfolio. So we're not taking undue risk or undue bets in one area versus the other. With infrastructure, we wanted to show here the yield component. So this is a proxy of the private infrastructure market, where we're looking at the S&P Global Infrastructure Index and the S&P 500 Index. In brown is the infrastructure index. In blue is the S&P 500 Index. You just get a clear sense of just how much yield you're getting in an infrastructure investment versus your traditional equity investment. So again, yield is the bigger component of return. And as we think about market volatility, once again, that's really what we're looking at as the biggest source of return when we think about an infrastructure investment. So that concludes the overview of the three new areas we wanted to introduce. And the next step here would be to go into the asset allocation review or asset allocation study. But with that, let me pause for a moment, see if there are any questions, anything you'd like me to go through in the overview of asset classes before I jump into the asset allocation study.
Thanks, Kwaku. I do have a couple of questions, and I think Fran has a few as well. And I don't want to go out of turn. So whoever wants to go first.
Go ahead, Billy.
So Kwaku, the first thing I have is, why would we do anything different than what we're doing now? Looking at the amount of money that we have in the fund, what the percentage of funding is, and what we see as a revenue stream coming from what we have in as the asset allocation now. And this might be something that you're going to cover later, but it looks to me like what we have been doing for a while has been working and covering the expenses going forward. So is there something there that you see differently, or a reason why we would change course?
No, that's a really good question, and I can definitely tackle that up front. Billy, you are correct. When we look at these studies through the lens of risk statistics, for example, it can paint a picture of like the needle not moving that much, right? So you are spot on with that observation, where if we jump into let's say the downside risk statistics, right? First and foremost, we're coming into this asset allocation with the lens of, oh, this has worked really, really well. And what we're looking to do, what Marquette is proposing, is tweaks around the periphery, right? So there's definitely a buy-in and an acknowledgement from this end that the asset allocation that is in place has done a really, really good job, especially in the bull markets that we've gone through. And when we look at these risk statistics, again, there's not a material difference between the mixes, particularly the current and mix C and mix D, which is where we'd like to gravitate the discussion to. Now, with that being said, when we think about downside risk, right, this is the lens that we have when we think about downside risk. If we end up missing and going negative, for example, in a down environment, the current mix is positioned to lose a little bit more than either mix C or D. Now, from a statistical standpoint, again, it's not that much. You look at 3.1, a negative 3.1 versus 2.9 or 2.8. That's not a big deal from a statistical standpoint. But what we also took a look at.
Oh, Kwaku, can you go back to that page?
Sure.
Before you get off of that page, you're focusing on downside risk, which is the bottom line. The downside probability is significantly higher on either of the options that you mentioned, if you look at the top line. So why are you not addressing that line? Why are you focusing on the line that seems to be more beneficial to the scenarios that you're proposing?
No, Fran, we can jump into that very quickly. So the downside probability does spike up a little bit, but let me show this really quickly. So 46% is a downside probability of the current mix, and then it goes to 47.4 or 47.7 in option C or D. So what we are doing here with the current mixes, and this will explain why the downside probability has increased a little bit, is we go from 715 in terms of the expected returns. The expected return comes down a little bit. And as a result of that, the downside probability does increase a little bit, right? But one of the reasons we're focusing more on the downside and the risk component is the comparison of volatility. When we look at the current mix, it's a return of 7.15 with a volatility of 11.32. And then when we look at mix C or mix D, we look at a reduction of 14 basis points in terms of excess return, but then the volatility is pretty meaningful in terms of the volatility coming down. So it's about 80 basis points in volatility coming down.
No, I get that. I get those differences, but I'm going to go back to what you said when you started introducing the various asset classes. You said the goal here is to talk about downside, right? And then now it's shifting to volatility. I mean, I know they both work in conjunction, but the downside probability is less than all other scenarios in the current portfolio that we have, according to page 7, right?
So, Fran, yes, according to page 7, and that's over a 10-year horizon.
I get
So,
it.
so over a 10-year horizon, yes, absolutely. It will smooth out any observations that are extreme over that 10-year period, right? But then when we look at the scenario analysis, let me jump into the scenario analysis just as an example, and we go from a 10-year period to a 3-year period as an example. You will see, for example, over a 3-year period, over that shorter period, it means that we will have to be comfortable absorbing a bigger loss with the current allocation versus one of the tweaks that we're recommending, which would mean that we have a little less downside to absorb in an extreme environment. So if we take let's say
I get that, but why would we look at 3 years versus 10? And the reason I ask that question is because every time that we've had a projection out on the annual asset allocation elsewhere, it's always been, well, we don't look at the short term. We always look at 10 years or more. But when we talked about the low vol, you showed a 1 month return, not 3 years, 1 month. Now you're talking about a 3-year return versus a 10-year return.
yeah.
But even if we look at the short period of time, right? I mean, I want to, in the executive summary sections, that's the section that shows that nice chart with the year-to-date returns for all the asset classes. But on
Yep.
3 different pages in there, you talk about small cap equities appearing to be attractive as large caps trade at historically high valuations. You then say small cap earnings seek to rebound in the aftermath of a period of sluggishness. And there's a reason I'm focusing on small cap. And then on page 42, you say small cap equities have tended to perform well when high yield spreads are low and may outperform going forward. That's what page 42 says in the executive summary. So I'm wondering why we would be taking 5% out of the small cap, because that's what the asset allocation shows. That's where the percentage is coming from, out of the small cap, when your own report projects that small cap may be outperforming. Again, I'm only mentioning this is short term, but even in the long term scenario, the option A, the current option, the baseline shows an 8.6% 3 years annualized return, whereas option A is 8.5, option B is 8.4, option C is 8.3, so on and so forth. I mean, I can go on, but the returns are better under the current scenario than any of the other options, and the downside probability on page 7 is the lowest. I get the volatility. I understand what you're saying, but the return is better. The downside probability is lower. So I go back to what Billy said. Why would we contemplate a change?
Yeah, and that's a
And
very, very
Kwaku, while you're doing that, can you also talk about the fees that would be involved in the 2 different scenarios?
Yeah, absolutely. So, firstly, Fran, again, with the current mix, because the expected return is coming down a little bit, the downside probability is going to go up, right? Because 7.15 expected return, that's going to get you to 7% more often than not than a mix that has the 7.01. So that does explain the slight spike up in the downside probability. And we definitely acknowledge that in those numbers. But the other thing we want to acknowledge in the numbers is examples of when you end up in, let's say, the 5th percentile in terms of the market selling off, and putting it in dollar terms, where you look at the current mix, for example, and you compare it to option C and option D. Again, the reason why we keep on focusing on the downside is we've seen the upside of the current mix. We acknowledge that the upside of the current mix works, but then for a plan that's around 75, 76% funded, has a 7% target rate of return, we're also just showing through the lens of, okay, what could, if there's a sell-off, what could happen? And we think about this, and it goes back to a 10-year period. So I wanted to show the stress test. Stress test just shows a 3-year period because it does, want to show over a short-term period what the dislocation is. So let's go back to the 10-year horizon. And over a 10-year horizon, fifth percentile scenario, option C and option D do hold up better from a base standpoint in terms of the value of the assets. So that would be an example of, we admit that the current allocation is doing well. I started by saying that it is doing well. It's done a good job. Where are areas we can improve? And the area we feel that we can improve is around that downside protection. So you look at a fifth percentile return, there is a difference of around 23 million in the value of option C and option D and the current mix. So that's why we continue to focus on the downside, because that is the selling point of the mixes that we're looking at versus where we currently are. Where we currently are, once again, has served us very, very well. But we again wanted to address the fact that there could be more volatility on the horizon. If there is a sell-off in the market, which is a pretty realistic thing for us to entertain, ultimately, what does the current mix mean versus option C and D? So just wanted to kind of expand on why we were focusing on the downside. It's not to slice and dice or look at anything in an advantageous way for any particular scenario. The reason why scenarios C and D make sense, in our opinion, is they just add a little bit more downside protection. So
Assuming global low vol does what you think it might do, right? Which proved
yes,
to be not correct during when financials didn't hold up the way we thought they would a couple years ago. Remember that?
yes.
Remember
So
the financials were getting battered? And Chris and I have talked about that several times. That's traditionally global low vol: financials, healthcare, utilities. Well, one of those three prongs, financials, got crushed when the market went down. And that was that. I don't know why that was. And you spoke to that a little bit earlier. But global low vol doesn't always do what it's supposed to do. And just as an aside, the name global low vol is a little misleading. Some people might think global low vol might be more non-US than US stocks, but it's not the case. If you look at the one option where the first option, global low vol, is incorporated, which I think is option C, right? Yeah. Option C is the first scenario. It actually increases our total US equity from 45% to 48.8%. So we're actually increasing our equity exposure in the US and decreasing the non-US equity. I think you would agree that right now, the non-US equity from a valuation standpoint is probably better positioned than the US equity. I'm not talking about a growth standpoint. I'm just talking about strictly fundamental valuation.
Yeah, no, we would agree with that. It has been very attractive since 2008 relative to the US stock market. And then going into the new administration, US versus non-US, if we do enter this strange period of trade wars and tariffs once again, there's probably more volatility expected from the non-US market versus the US market. But Fran, yes, you are correct in that.
So I agree. We've been waiting for Japan has been attractively valued forever, right?
Yes,
and Chris and I talked. I get that. So valuation and is fundamental valuation is one thing, and how long are you going to wait for it? But what you said about tariffs, what you said about things like that, to me, that's partially market timing, right? We want to look for the long term. I mean,
correct.
This administration is one administration. It's a
Correct.
4-year period at most. So we will see what happens. But I think global low vol traditionally, historically, has been what it's been. But we know we can't always count on that, right? I mean, we see there have been a lot of variations to that recently. So that's my concern. And And I will an aside comment about infrastructure. And I know the current outgoing administration really pushed infrastructure as sponsored by the government and so on and so forth. I know this is a different type of infrastructure you're talking about, but I haven't heard that same type of emphasis on the incoming administration as far as expenditures to infrastructure, increasing infrastructure. And I know this is more of a private sort of infrastructure investments, but I don't hear that same emphasis. And quite frankly, I don't know if it ever got off the ground, very well in
Right.
the last administration either. So I get
Correct.
that there's still a need for it, but it seems like, again, more of a timing issue when the, I mean, it seems like we're emphasizing certain things when
Correct.
when we're not emphasizing parts of what your scenarios talk about concerning small caps going forward. I mean, I'm just reading your report on
Sure.
page 20, 29, 30, and 42. They all seem to have a positive outlook for small caps at a time when you're proposing we take 5% away from small caps. May turn out right, it may turn out wrong, but why take that gamble, I guess is what I'm saying. When
Yeah.
the returns of this current portfolio have been good since inception, and especially over the 3, 5, and 10-year periods. So any period you want to look at, the portfolio has been very good. So before we got in, I mean, it would be impossible to go through page by page. And that's why I just wanted to give a little bit of a summary of what my thinking was and Rob's thinking. And we discussed this, is that I could see possibly option A but I think I'm most comfortable with the current option. But C, D, and E, I'm not seeing it.
So from our perspective, Kwaku, and I really value the time and effort you put into looking at all these things for us, bringing it back, giving us options, and so we can see a global view, not to talk about global, but to be able to see all of it and possible changes that might make sense. And should we look at this? Did we not think about that? So I
Right.
like the push and pull of all of that,
Right.
and trying to figure out where to go. I think you've been around long enough, and we've done this a few times when managers, and you're not a manager obviously, but when managers come in during the 04, the 08, the 12, and they tell us all about capturing the upside while protecting against the downside, that
Right.
kind of makes me a little angry when they do it, because we've seen, while they say that, then they come back in and say, well, nobody could have predicted.
Right.
Nobody, I mean,
Right.
we do it on this level, but who
Right.
would have ever well, when you tell me you're protecting me on the downside, to me, that means whatever the downside is, you're going to give a better result than what the
Yes.
other investments would do. And when
Yes.
they don't do that, they say, well, this was a once in 100 year. This was a once in 1,000 year. Well, a 400% tariff is a once in a whatever year kind of thing
Right.
that we can't protect against. Right. And so
Yes.
these kind of things, when I hear protect me on the downside, that doesn't hold as much weight as this makes sense because you're invested in A and we can get you a higher return in B for the same risk, the same level with no real changes. And so it makes more sense to take $2 instead of $1. And those I can
Absolutely.
understand. I don't
Absolutely.
see that in this, and I'm wondering if I'm missing it, or is that a higher risk that we are taking if we went to a different option? And again, if we're 40% funded, we have different conversations. At 70
Yes.
something percent funded, I'm trying to see why I would move in the scenarios that you presented. I liked them. I like the way you put it out. I'm just looking for that reasoning there.
Yeah, absolutely. And in fact, I think to Fran's comment, he really hit it on the head where when we were going through the analysis and we were going through the portfolio, again, like all the historical returns are good, right? We look at upsides, we look at the performance of the portfolio. it's done a really, really, really good job. So in terms of looking and stress testing and really just tearing everything apart a little bit, the area that we wanted to bring you guys to was, I'll put it this way, we weren't going to come into this meeting and say, look, you need to get higher returns from what you're doing, because that's no, the portfolio has been doing exactly what it's needed to do in terms of hitting that target rate of return. But coming to the table today, what we did want to highlight here was the fact that while the portfolio has been doing very, very well, we want to make sure that there are no surprises, that if the market sells off, this is the expected behavior of the portfolio. So you have all been used to very, very good returns, but we want to highlight the fact that the asset classes that we're in, if something happens in the market, these are the scenarios that we may in fact face. And if the scenario that we present during a sell-off is one that you guys end up saying, you know what, we can take a little bit of alpha off the table to help protect from the downside, that's the direction we really wanted to take the conversation. And if we look at this particular page here, the numbers really lend themselves to why we were looking at the world this way. So, Fran, to your question around small caps, right? We still are big proponents of small caps. We still believe that we should allow the asset allocation to creep up or creep down, particularly to let the better performing asset classes, kind of creep up to that plus minus 5% range. But we look at small cap and we look at mid cap. Adding mid cap is, in our opinion, it's a 40% reduction. And again, I don't bring up downside to irritate or belabor the point, but the lens we are looking at, right? The portfolio is doing really well. We've been at the top of a bull market. The market has outperformed. So naturally, we want to bring it to, okay, where are the areas we can essentially tweak things? What are the areas that can help the portfolio in the event of X, Y, and Z happening? And here's an example with mid cap. You have a 7.7% expected return over the 10-year period. The volatility is pretty materially lower than small cap. So as we think about the overall portfolio return streams, we go through a tough period of performance in the market. That negative 2.4%, for example, in a fifth percentile return versus that 3.3% for small cap, that's something that's very palatable, very digestible, and it doesn't take away from our end goal of hitting that 7% as consistently as possible. With the global low vol, the reason why it's a smaller portion of the portfolio, and it's an area where we've taken a little bit away from fixed income as well. So one of the areas you'll see that we've taken away from, again, not hugely, but a little bit, is fixed income. So fixed income has gone through this weird dance of it wasn't returning anything. Suddenly it started returning a lot, but the markets weren't really able to benefit from fixed income returning something because the Fed ended up raising rates 500% literally overnight. We've gone from a period where we're not trying to time rates, but it does look like rates will come down again. The steady state of rates, we're not 100% sure what that number is going to be, but right now the market's projecting around 3%. So substituting a little bit of that fixed income allocation, we don't want to put it all back in equities. That's where global low vol, also is, a thoughtful play from our end, where it's some equity exposure. We're getting more than fixed income, and then the volatility is significantly less than what we can expect either on the domestic side as well as the international side. And then we compare it to, let's say, high yield, less volatility. Or I should say the volatility is more or less in line with what we're getting from high yield. So, Billy,
So you're talking about the 11 versus 12.3.
Yes, exactly.
Yeah. And so that's in line. Got it. You're saying that's in line, but on the overall portfolio, when you look at the volatility, I just want to make sure I'm understanding this. When you look at the volatility number in the overall scenario, a basis point or two you pointed to earlier was a significant difference in volatility. So the difference between 0.63 and let's say 0.65 or 0.66 is significant, but 12.3 to 11 is not significant. Just want to make
No,
sure
no.
I'm understanding it correctly.
Yeah, so this is and this is definitely comparing a portfolio at the portfolio level to an
Right.
asset class, right? So
Mhm.
at the portfolio level, that's the entire level of assets. At the asset class level, it is important, but we're looking at a 3% allocation, and that 3% allocation, that 1% of that 3% allocation, in the context of the overall allocation it has, it's not as meaningful, right? But then we look at
Right.
the overall 700 million, the 1 or 2 basis points is going to be a lot more significant in the context of the bigger pool. So that's
Got it.
that
Got it
that's
on
the
the
thinking there.
volatility. So is that more important in your opinion? Is that volatility measure more important in your opinion than the conclusion that you make about the probability of downside? Now, we don't have crystal balls, right? But the numbers are here. I mean, the numbers are here based on whatever you base them on. I don't know how you're determining what the probability of downside is, but on page 7, you have the probability of downside and you have 7% in parentheses next to it. But the probability of downside of the current portfolio is 46%. And let me make
Yes.
sure I'm reading that right. So you think
Yes.
there's a 46% chance of downside with the current portfolio?
Of downside of not meeting the 7%
This,
target.
right, right.
Yes.
But with option C or D, you think it's 47 point, well, I'll take the average of the two of them, 47.5% roughly for both
That's
of
correct.
those, which is
Because
higher, right?
it is higher because the expected return goes
Is
down
lower,
by
right,
14 basis points. Correct.
right. But downside from what? Downside from the assumed rate of return, downside from
Correct.
the 7% assumed rate of return.
Correct.
Got it.
Correct.
So even C and D, you think will have a higher percentage of being lower than the assumed rate of return versus the current portfolio,
So there is the slight uptick. Yes, there is.
which remember, when a pension fund, and forget the investment for a second, but
Yep.
when a pension fund does not meet its assumed rate of return, that means greater contribution from the
Yes.
entity, whether it be a city, PGW, whoever that would be. So
That
that,
is
I
correct.
think that has to be taken into consideration. If there is a downturn, that means it's not always, but the economy's probably struggling a little bit too. So for a municipality or a governmental entity to come up with the extra contribution, it would also be challenging during that period of time. So I just want to
Absolutely.
think about the pension part of it, the management of the pension part of it, as well as the investment part of it. And I think that would lend itself to being a little more cautious on reducing the possibility of downside, not the volatility, but
Yep.
reducing the possibility of downside. I want to distinguish between the two, so you understand where I'm coming from.
Yeah,
So
absolutely.
that's a really interesting point, Fran, and that was something that I was looking at when we were looking at these scenarios as he was talking. And so we've outperformed the 7% for several years. And the city has also put in more money than what was required in this fund over a period of time. And so while we don't want to take that for granted or think that that is a cushion, does that give us a better thought of we can, not to say afford, but we can sustain a small underperformance of the 7% for a year, 2 years, 3 years, where it would level off from what they put in extra. Not that we ever want to underperform, or we just want to hit our mark. I heard somebody say we don't want to overperform, but we like to overperform. But do we have a cushion there that makes sense?
That's to you, Kueko. I think that question. It's a good question.
Sure. And I would say in terms of looking at all of this analysis and these scenarios, I would say that on the one hand, we've discussed downside, right? We've discussed the downside of the current allocation, the current mix. We've discussed the potential
nauseam, yes.
upside. Yes, we've discussed the potential upside of having more of a lower volatility approach. So look, my read of the situation is essentially this, where on page 9, where we look at option C or D, where in a 5th percentile environment, these two mixes do better. It doesn't appear that this is enough of a compelling case to say, okay, this 5th percentile statistic you're showing us, this is more than compelling to push us to increase the downside probability of the portfolio, even if it's by a percentage point. We're comfortable with the current mix, the potential downside that you protected in the current mix. And at this stage, there are a couple of things we can do. We can either table the conversation around the asset allocation with the understanding that we've kind of looked at more defensive scenarios, and given the risk tolerance that we've heard from you all, the downside scenario is something that's been good to discuss, but it's not compelling enough to move. Or we could also take a look at some additional mixes that incorporate a little bit of the feedback that's been received today around the downside probability, and ultimately coming back to discuss those mixes. But the goal today, again, coming in, and I think I said this to Chris, was coming in, the performance has been good. Coming in, we have to kind of look at it from a different lens of, okay, everything's really, really good. We have to look at it from the lens of, okay, what happens if something bad happens in the portfolio? And in discussing something bad and presenting scenarios that would protect should the event something bad happens, it doesn't appear that at this point these are compelling enough reasons to kind of deviate from what we're doing. And we would also consider that to be a good objective of an asset allocation study. It doesn't always mean that we have to change immediately. It doesn't mean that we come in and present a new mix and then we implement a new mix, but maybe the discussion is there to get tabled for a future date around downside protection and ways in which we can incorporate. So I do want to, again, reemphasize that we came into this with the understanding that the returns have been really good, portfolio has been really good, and the lens we wanted to have was, okay, what happens when things aren't really good? And it just sounds like the numbers here.
Yeah, no, Quaker, I like how you distinguish between the two, downside protection versus downside probability. And I think one comes after the other. I think downside protection is second. And the reason it's second is because you have to know what the chances of your portfolio going to the downside are first, right? And then if you can minimize the downside probability, as you call it, and that this is a great analysis, by the way, it's very helpful. But my idea is you limit the downside probability as much as you can, and then institute the protections consistent with that. But I see the current scenario as the best downside probability. I mean, the least opportunity for the portfolio to go down. Again, based on your analysis, not mine.
Correct.
But none of us have a crystal ball. Look, it could be very well that option, whatever, one of the other options, protect better on the downside, or don't go down as much. But the downside probability here has to be primary to me. And then secondary is, okay, we have X percentage of chance of this portfolio going down. What do we do to protect it? So
Right.
I think you're right on with the second answer, right? But the first answer, I think the current situation that we have is the least chance for the portfolio to go down, at least based on your stats.
Correct.
So
Correct.
anyway, that's the way I'm looking at it, just for the benefit of the discussion, just in case I wasn't communicating it effectively.
And Quaku, I always admire your perceptiveness.
Oh, not a problem, Billy. And the other thing we'll mention here is, the target rate of return whenever that changes, that's also a good opportunity to revisit these discussions. So again, coming in, I don't know what the analogy is. Like the current allocations, Jake Paul, and the mixes we put forward were Mike Tyson. But the point is, we had a strong story to begin with, and we really just wanted to again really just exhaust the conversation around, okay, we're looking at this state of the world, but if another state of the world happens, we as fiduciaries, have we kind of gone through the pros and cons? Have we looked at how things are currently allocated? If there is a sell-off, we're all kind of on the same page with respect to we all took on these risks and we were aware that there were ways to kind of diversify, but again, there wasn't a compelling enough case at this point to make the change. And then as and when we look at changes to the discount rate, that could in fact be that thoughtful entry point to say, okay, now the downside probability is within a realm that makes a lot of sense now, given that we don't have to hit 7, let's say it's 6.95. And now let's talk about some of these other options. So it could be something that we revisit in a couple of quarters. And just keep it ongoing as an ongoing conversation. But yeah, the very tough thing was coming in, looking at this from many different angles and looking at the asset allocation that had really done a good job and pretty consistently for you guys.
Quaco, could you,
I hope
Go
in
ahead,
your
Billy.
analogy that both fighters held on and we're Jake Paul and we actually survive and win at the end.
Yeah,
I
no,
hope that's
definitely.
the,
Definitely.
they
Definitely.
both made it through the storm, but Jake Paul won at the end.
Yes, absolutely.
well, more importantly, they both got paid, which I think was the goal.
Yes,
The,
exactly.
Quaco, I would love to see, and you could work with Chris, is more of an analysis of the deficiency of the current portfolio by not having mid-cap exposure.
Okay.
Because you made a great point with that, and it is a good point. I mean, I think that might be a hole, right? At some
Yes.
point, so,
Perfect.
putting aside the global low vol and the infrastructure first, just for now, just for, like you said, for now, but I think that the mid-cap, deficiency is something that isn't, I think, important to take a look at.
Absolutely. So we can definitely do that. And I think that would again just incorporate a little bit more flexibility in again something that's doing a really good job. But how do we kind of tweak it where it's additive and doesn't take away from the projections, the downside probability, and then ultimately it's not too much of a change, right? Small cap, some of the small cap exposure will have some mid cap in it. Just because of size creep. Some of the large cap exposure will have mid cap to it because of the size creep. So that's less of a leap forward in the asset allocation if we take a look at that. So we can definitely do that.
And Chris, Copeland is listed as a core small cap. If I remember correctly, isn't it slant towards value, or am I thinking of something else?
I think that might be right slightly. And it may
Value
depend.
tilt.
Value
Value
tilt,
tilt,
okay.
slight
Yeah.
value tilt. Look, I think there was a lot of really good points and questions. I mean, there's a couple other things, I plan to work on with Quaco. One, and perhaps I should have done this before, but the current allocation, at least in practice, even if it's not specifically listed, does have somewhere, let's call it between 1% and 3% cash. And that in the model isn't reflected, right? Under the current allocation,
Correct.
it's at 0.
Yes.
The reality is that we run somewhere between maybe 1 and 2.5. So even if it's just for my own edification, I'd kind of like to see how that changes some of the statistics and the portfolio characteristics, because I have a feeling that would change things a little. The second thing is, and just looking at the October flash report, in my mind, this also points to the importance, whether it's at a staff level and then ultimately at a commission level, of rebalancing the portfolio appropriately. Because I think right now, Quaco, if I'm right, we're at about 33% fixed income. Now
Correct.
that's excluding cash. So if you count cash as fixed income, then we really are at about a 65-35, right? If we're counting cash as a fixed income proxy. My point being, though, if we have a run up or a downturn and we see those weights move significantly, we may want to be a little bit more, I don't want to say aggressive, but consistent about rebalancing. Because if we don't, and we get more like a 68-32 or a 70-30, then some of those downside scenarios are going to be magnified, right? Like we're going to magnify significantly in a really volatile market. So I just wanted to throw those couple things out. Just also wanted to mention, for the record, because I heard it discussed very briefly, as of the last actuarial report, the market value funding level was just under 80%, was at 79.96. On an actuarial value, it was 77.5. So just again, for the record, just wanted to throw that out there. And then since we're just talking about the cash, as of this morning, we have just under 16 million in cash, and that's with a portfolio that's around 677.3 million. So
They're
with
they're
that,
all good points, Chris, especially
Right.
that if you look at page 5 of the title is Executive Summary, Sinking Fund Commission. It's the current allocation versus the target allocation. It's that little pie chart with the three 32.3 versus 35%
Right.
for fixed income. And I think your point is you take the difference between those two and the cash percentage, and assuming some portion of that cash gets allocated, you may not even have to reduce the small cap in order to incorporate mid cap
Correct.
necessarily, even though you might want to. I mean, I'm just saying you're right. Those percentages can make a difference in the way things are divvied up. You're right.
Yep.
That's a good
That's right.
point.
That's right.
Mhm.
So, Don, any questions or anyone else before we move to the fund performance? I don't want to cut anybody out or off.
Man, that was a great discussion, and I think the takeaway is we're going to stay the course. So,
Okay.
thank you for that input. So, should
Okay.
we move forward with item number 3 on the agenda?
Yep. Baker, if you want to go through the October performance.
Sure. So I will briefly go through the market environment, just 1 or 2 pages, and then jump into the actual performance of the portfolio, which again, one of the themes we hit upon during the asset allocation was it was good performance. The market sold off. We did a little bit better than the market in our portfolio. And then over the long term, the returns continue to trend the right way from a tracking error standpoint relative to the index. But in terms of actual market returns, we do see through the end of October, again, a strong equity market, U.S. equity market up over 21%. When we think about the S&P 500 or the Russell 1000, and then the broad U.S. market, that's the Russell 3000, that's large cap, mid cap, small cap, with a huge tilt towards large cap, up 19.7. Even fixed income, for all of its woes, slightly in the positive at 1.9%, and then the international markets up as well. So a pretty nice period of performance when we think about the period ending October. Now, it's a nice period of performance, but it doesn't mean a non-volatile period of performance. So this market has really been marred by strong returns on the upside, but then just a lot of giving back ground. It's kind of like watching the Chicago Bears play, where there's a strong performance on the offense, and then something is just given back, and no one can really explain why. But the S&P 500 for the quarter was down. As we look across the major indices, both U.S. and non-U.S., these indices were down. And there are a couple of reasons for it. So October, there was the notion of, okay, what's going to happen if party X or party Y wins the election. So that was one big reason behind the noise we saw in the market. Another big reason were some of the indicators coming out. On the one hand, we have a Fed that's a little bit more dovish today as compared to back in 2022. By dovish, they are more accommodative of bringing rates down. But then some of the indicators coming out, whether it's the employment figures, whether it's CPI, these are painting pretty much a mixed picture with respect to will rates actually come down because the indicators the Fed's looking at aren't as strong as we'd like to see them. So the takeaway here is the market doesn't like uncertainty. There was a lot of uncertainty in October, more uncertainty in November that we'll discuss at a future meeting, but that uncertainty led to more volatility. But on the right-hand side, we still look at year-to-date very strong results across the major asset classes, and that's the key takeaway for all of the uncertainty in the market. And we'll use NVIDIA as kind of a break point for the uncertainty that we've seen post-election. The market is kind of like, the attention span of a gnat, where all of a sudden it's focused on one thing and then it will focus on the next thing that's more rosy. So NVIDIA, for example, has led a pretty nice market rally. It's, reported, is it 74 cents earnings per share? The market has really held on to that. So for all the bad news the market absorbs and feels uncertain about, it does look for good news, and that good news, thankfully, has put the market, in the direction we'd like to see it. I'll just jump to asset class performance really, really quickly, and then we'll jump into the actual performance for the sinking fund. So for the month of October, we did see fixed income down. Now, when we think about our fixed income allocation, we have intermediate exposure. So the intermediate exposure, less duration, meaning less sensitivity to interest rate fluctuations up and down. And then we have some high yield exposure that has more of a correlation to the equity markets. So as we think about some of the noise that the ag index saw, some of our allocation is actually buffered away from that. As we look at the equity allocation that we have also, leaning into passive exposure in the more efficient areas of the market. So large cap, we did see a little bit of a sell-off in large cap for the month period, but year to date, again, comfortably over 20%. Small cap, an area of the market that is positioned to do well as we think about rates going down and we think about a so-called soft landing in the economy. A soft landing is typically good for a small cap company because a small cap company is more beholden to its domestic economy. A large cap, a multinational, is going to depend more on global trade to meet earnings and so on. Small cap can focus more on the domestic economy. So rates coming down, a potential soft landing. This is essentially baking in a pretty nice tailwind for small cap. And it's going to be a similar theme for mid cap, where we think about mid cap companies. These are companies that are big enough to have some multinational operations, but not so big that they overly rely on overseas markets to drive their growth. So mid cap, we are also looking at pretty strong positioning for mid cap as we think about rates potentially coming down. And then the international markets, the one thing I'll point to here, just to highlight why the US market has done so well. As we know, technology has been such a significant driver of performance, but then the economy doing well, materials have done pretty well. Real estate has rebounded nicely off the strength of rates coming down. Utilities have incorporated some of the noise and volatility and uncertainty in the market. So we're seeing a lot of sectors do well, but the most consistent performer we've seen in this post-COVID period has really been technology. And if we look at technology and communication services, the best performer, that's 41% of the S&P 500 coming in from that tech play. So definitely the most compelling driver of returns in the US market. And as we look at the non-US market, the non-US market really is, facing two headwinds. The non-US market is doing well, so it's that that relativity story where the non-US market is still up high single digits, 6.8% for the EFI, 8.6% for the ACWI ex-US. But the big tailwinds we've seen in the non-US market are currency and then ultimately a lower weighting to technology. So we mentioned 41% for the US market in technology. When we think about technology in the non-US market, you're looking at 13% in your traditional IT, and then communication services 6%. So that's 19%. That's less than half of what the US market has. So let's jump into the portfolio now. And for the portfolio, unless there's any questions over the macro environment, we'll jump into the portfolio returns.
Kwaku, do you have any comments, anything you want to talk about concerning the situation in Europe right now?
And Fran, would that be the rise of populism? Would that be Ukraine?
Yeah, I don't care what it is, just as it concerns, our portfolio and international equities.
Sure. So I would say when we think about international equity exposure, and we'll jump into this in the return stream in a little bit, but we have managers that are outside of the indexes. Ernest Partners, they're a little bit more conservative in nature in terms of the markets they operate in. Also the same with Acadian with an ACWI ex-US portfolio. So I think of some of the areas that are trouble spots. Russia, for example, by default, we were forced to deal with the Russia equation where there was a forced divestment away. Germany, the UK, France, other economies, they are struggling and they're going through their own identity crisis in terms of Britain, you had Brexit. There's this slow admission that Brexit perhaps wasn't the right thing. So you now have a new government in that's trying to do that fine dance of acknowledging that Brexit wasn't the right move, but still adhering to that populist movement. And then the other parts of Europe, you've got, it's weird. You've got the rise of nationalism in Germany once again, a nationalist party, very inward looking and so on. All of that is a lot of noise to say that when we think about the US, and I always go back to the US, and this makes for good arguments with my relatives where they'll talk about US policy and then I'll kind of say, but yeah, look at your part of the world. The US is still the best house on the bad block, right? And I think internationally, I think that there's going to be more volatility as we think about Russia, Ukraine, however that concludes, more volatility. Someone is going to be upset with how the war concludes, whether it's a continuation of the offense in Ukraine, or if Russia does just come in and annex Ukraine, that's going to be a lot of noise, a lot of volatility. Germany, again, you have more of a populist movement, any type of anti-immigration move, particularly in Europe where populations are low and you need a workforce that's willing to come in and work, but you're not willing to kind of bring people in from other countries. Again, that should be contractionary. So I view the non-US market as still in a delicate position, but these managers are still looking to find spots and companies that are more on the conservative end, so less beholden to like the whipsaws of immigration and so on. So here's an example with both Acadian and Ernest, they may have an international stock that is a multinational that's more of a US company, right? When all is said and done, but the bulk of its revenues come in from the international market. On the one hand, revenues may come down, but this won't be hit by, let's say, currency, right? So that essentially offsets everything. So I would expect that international managers, the international allocation will likely, like it did this year, hold up well, high single digits, but US market will be a lot stronger. And it's for the very reasons just mentioned. Europe just has so much going on in terms of its new identity in this post-World War II environment where Russia and China are kind of duking it out to be the next superpower. I think a lot of countries in Europe, Britain in particular, are feeling the brunt of that. So ultimately, being with more conservative managers, I think that on the active side is a very prudent exercising of the international bet. So I would expect our managers to do well as there's more volatility. And in fact, I would say that with Earnest Partners, yeah, we saw this with Earnest, and we also saw this with Acadian. October was a pretty volatile month. I know it's just a 1 month period, but we see here during that volatile period, both of these managers held up pretty nicely, 2.9% versus that negative 4.9. So, up 200 basis points relative, and then up 90 basis points relative for Earnest Partners. So again, being a lot more conservative, I would say, is probably the right strategy for international. And the managers we have in play have done a nice job.
Quaku does and I thank you for that. And do all of those mitigating or factors or moving parts in Europe, which you don't know how they're going to end up, does that still lend itself to an index? Or do you believe that the active managers being able to position themselves accordingly are a better bet?
So that's a really good question. So I would say that index exposure still makes sense in our
Okay.
opinion, because over the long term, some of the noise will wash out. But then also, by default, and we've looked at this for the other plan, some of the state statute requirements have been helpful in terms of just screening out certain actors or players or themes within a portfolio as well. So our passive exposure is a little different from like just the core index exposure. So I think adding all those things together, we've got two active managers that are making different bets versus the index. We do screen out certain stocks on the passive. I would still say that it makes sense to have that passive sliver with Rumline.
Thank you. I appreciate it. Thanks.
And really, I think on the theme of the asset allocation, it doesn't mean that this won't change at any point where, if in 12 months, for example, there's an announcement with any of the managers, we'd want to take a bigger look. But the oversight of this portfolio has been, very strong in terms of the quality of the managers, the performance of the managers. There aren't any seismic changes we see when we go through the returns that we're looking to implement. And in fact, I can jump into the performance right now, just to kind of emphasize that point. The fixed income composite, for example, Barksdale has held up pretty nicely for us from a performance standpoint. We're not looking at significant deviation relative to the benchmark. MetLife, this is a player that's done a really good job in terms of just adding some credit exposure and diversifying away from the ag. And then with Garcia Hamilton, this is one area of the portfolio, and we've discussed this, in other meetings on other pools of assets, where this is a manager where over the long term, they've done a really, really good job. The challenge with them is the volatility that can come from the duration bet that they make. Right now, they've extended out duration, and that's the right bet when you think about the long-term path of interest rates. The long-term path of interest rates is to come down, but the challenge is rates are poised to come down, but then the market has spiked up, right? We've seen the supply and demand and investor fears kind of push yields up, and I don't think that was expected by the majority of players in the marketplace. So events like that will lead to more tracking error for Garcia Hamilton, but that's in line with their style when we think about a big duration play. So for the 1 month period in October, you'll see significant tracking error relative to the index. But then we go back to September, and in September, they had such a strong tailwind built in because rates went down 50 basis points. And ultimately, that led to a really nice return for them. So, Garcia Hamilton, we expect more tracking error to come from them up until the point that rates do settle. With Sky Harbor, this is your more conservative high yield manager. So as credit does get rewarded and all types of credit do get rewarded, we do expect them to lag a little bit. When we go through a period where we saw like high yield sell off during the energy, was it 2013, 2014, where everyone was piling into high yield, everyone was piling into the energy theme. There was a huge dislocation. Then all of a sudden, the quality managers really stood above. I would say that we're in a similar point in the cycle where there's been not enough yield out there. So Sky Harbor, their relative lagging makes a lot of sense. Year to date, they're holding up well, and we expect them to do well over a full cycle. We're continuing to watch them just because of the integration with Pew, but that's going well. Pew just actually announced some new portfolio managers on the core side. Things seem to be taking in their stride with the integration. On the domestic side, the Rumline allocation, Northern Trust, performing in line with the index. PineBridge, I think this is an area where, it's tough, it's challenging to outperform consistently when we think about large cap, but it's a pretty competitive track record that they've got. So from time to time, this could be an area of the portfolio that we take a look at. Copeland, this is leaning more on the value side. So we would expect as November numbers come in, volatility kind of spikes up in the market, that this should hold up well. Particularly as rates go down, your present value of your dividend paying stock should increase. So we think that they're positioned pretty nicely. Small cap index holding up pretty nicely here in terms of a tracking error standpoint. And then we just went through the international discussion. So the shape of the portfolio, is nice. The managers are doing their end of the bargain. The ones that, are deviating a little bit, I think the reasons are very explainable. And then from a performance standpoint, again, the performance, really nice tracking error when we think about, longer term and then shorter term. We're seeing that downside protection more often than not. So that would conclude the overview of the performance report. But if there are any questions, more than happy to talk markets, talk about January 21st, 2025 and what that may mean. But we can also wait till 2025 and see what's actually going to happen.
Excellent presentation.
I'm sorry, Don.
Go ahead.
And Kwaku, on that point, I know that was kind of tongue in cheek with the January 21st, 25, but there have been comments and statements that were made that things would happen before January 21st, as far as the Ukraine war and things that are happening. So I know we're not scheduled to meet again until we get into 25, but I would ask that if there's anything that you see that would have a huge impact in our portfolio and the world, the way that it's going to change, that you would get back to us and we would be able to put a different meeting together to be able to make whatever changes you think we would, if we should make any. But I'm sure the conversation will go back and forth between you and Chris will relay it to us and we'll stay on top of it because I have a feeling that there's going to be a lot of shifting and movement. We may or may not want to play a part in any of the adjustments, if that makes sense.
Absolutely.
Any other questions?
No.
Well, is there any new business that we need to address, Christopher?
Now, just as it pertains to the next meeting in January of 2025, just a reminder that I'll make the short presentation, the short report on the custody bank recommendation. So that will be on the agenda. I just wanted to flag that. But other than that, Don, no, nothing else.
All right, thank you. Thank you all. Is there a motion to adjourn?
So moved.
Second?
Second,
Have a great week, guys and ladies. Thank you
thank
all.
you.
Have a good
Thank you.
Thanksgiving, guys.
Happy
Thanks,
Yeah.
everybody.
Thank you, Quaker.
you.
Thank you.
Thank you.